Hi. Let's learn about kiting and how it works with checks and securities. Kiting is the fraudulent use of a financial instrument to obtain additional credit that is not authorized. Kiting encompasses two main types of fraud. Carried out within the banking system, kiting typically involves passing a series of checks at two or more banking institutions, using accounts that have insufficient funds. Relying on the float time required for a check deposited at one bank to clear at another, the kiter typically writes a check at the first bank against an account at the other. Before that check clears, they then withdraw the funds from the second bank account and deposit the funds back into the first. The process may then be repeated in the opposite order, sometimes repeatedly. The net result is a series of fraudulent withdrawals that rely on being a step ahead of the fraudulent check on which they are based having cleared. A variant of check kiting is known as retail kiting. This relies on cashing a bad check at a retailer to purchase an item. Then, before that check has cleared, the kiter writes another check, number 2, which may include, or entirely comprise, a cashback payment. The cash from check number 2 is then deposited into the account, to allow check number 1 to clear. The fraud is then repeated in order to cover check number 2 and may be sustained in order to stay ahead of the float and fraudulently obtain a series of items and cash withdrawals. Kiting that involves misrepresenting securities generally occurs when securities firms flout SEC regulations regarding the timely delivery of buy and sell transactions, which must be completed within a 3-day settlement period. If a firm fails to receive the securities within that time frame, it is required to purchase the shortage on the open market and charge the delinquent firm for any associated fees. The delinquent firm is considered to be practicing the fraudulent act of kiting if it fails to purchase the securities on the open market and maintains a short position, delays delivery, or takes part in transactions contrary to the proper settlement of trades. Here are 3 key takeaways. 1. Kiting involves the illegal use of financial instruments to fraudulently obtain additional credit. 2. Securities firms kite if they fail to follow SEC rules around obtaining securities in a timely way. 3. Check kiting targets banks or retailers through a series of bad checks, sometimes drawn on multiple accounts. Hope this would help. Thanks for watching.